I'm Peter McCarville for NCD News. The business world is supposed to be results driven, and it's generally accepted that if you fail to deliver, you won't get very far, you won't reap the same rewards as your peers, and your future prospects will be somewhat limited unless you pull your finger out. That is, of course, unless you work in finance, in which case there is a chance that you may be in line for a hefty bonus this year. For example, the Royal Bank of Scotland, which, after receiving £20 billion of UK taxpayers' money, has set aside £1.79 billion to reward its staff for outstanding performance. Alarmingly, an undisclosed sum is to go to the investment banking division for the first half of the year, the same division that caused a £5.9 billion write-down that wiped out the bank's profits for the same period. Throw on the recent publicity regarding RBS's £300,000 secret party for their executives, and it's no wonder that some banks have started cancelling their parties. Though this is only to avoid bad publicity, as cancellation of these parties at such a late stage will still cost millions. We're also slightly sceptical of Barclays' sudden U-turn on pleas for government aid, after the revelations that millions are being set aside for executive bonus payments by the major banks. Barclays announced that it would no longer need the £5 billion lifeline, that it would be able to raise the money itself. Despite mutiny by Barclays shareholders, a less than favourable deal was struck with a Middle East consortium. The bank then decided to scrap its bonus scheme for this year, with the exception of Roger Jenkins, head of principal investing in private equity, who received £5.9 million, paltry sum compared with Bob Diamond's estimated £25 million the previous year. Naturally, when financial institutions allow these golden backslaps, they leave themselves open to such intense criticism, especially when the money could be directed somewhere else in the economy. A report in The Guardian revealed that Goldman Sachs, Citigroup, JP Morgan, Merrill Lynch and Lehman Brothers had set aside $70 billion in pay and bonuses for the first 9 months of the year. The first 4 banks named are in line to receive a share of the $700 billion US bailout, whilst Lehman Brothers made sure to set aside considerable bonus payouts prior to its collapse. Insurance giant AIG had to negotiate an emergency loan with the American Federal Reserve of $85 billion to underwrite losses incurred during the credit crisis. The following week, however, saw AIG executives engage in a Californian retreat, which boasted spa treatments, banquets and golf outings. AIG reported that the $444,000 trip was a reward for the top-performing life insurance agents and had been planned before the bailout. Well, as long as they had a good reason. But even after the attention that extravagance drew, AIG executives racked up another $86,000 bill on an English hunting trip, only days after they had negotiated an additional $37.8 billion loan from the Federal Reserve. It must be said, though, that the newly elected AIG chairman and CEO Edward Liddy will only receive an annual base salary of $1 for 2008 and 2009, which is worlds apart from the $14.3 million that the previous CEO, Martin Sullivan, received in 2007. Across the board, banks seem to be getting away with anything they please, whilst the smaller man suffers. A handful of buffoons are handed bonuses and backrooms, whilst thousands of cashiers and receptionists' Christmas parties are cancelled to avoid bad publicity. Fully aware that any political party in power in the UK simply must dive in and rescue even the worst financial blunders made by these large financial institutions, seems to have given them licence to behave like spoilt children. Sadly, it seems that smacking children really has been banned in the UK. Maybe we could send them to their mansions and make them think about what they've done. I'm Peter McCarville for NCD News. Cheers.